And then we have perhaps one of the smartest traders ever that's manning the Treasury Department right now. So what he's got to be thinking is that, okay, my objective is to minimize my long-term borrowing cost. And for the US, that's somewhere between 10 to 30 years. I could either borrow and refinance at 4.2%, which is the rate right now. That rate will gradually come down because the ceiling right now is 4.5. That's a Fed rate is 4.5. Short-term rates can't go much higher than 4.5. One scenario that they could play is they're gonna issue shorter treasuries for this year and maybe next, wait for long-term interest rates to come down. And because they're not issuing long-term treasuries, there's going to be a supply shock on the long end. And when the narratives of the tariffs driving inflation, when that comes down, right, the long end of the curve will come down, right? And when it's sufficiently low, the Treasury will then start issuing more debt on the long end. And because in the past a year ago, short-term interest rate was at 5%, and we were at 5% interest rate for 2 years, 22 and 23. So all those 5% treasuries are going to mature, and they're going to be replaced by 3%, 3.5% longer-term treasuries. So that's right there. That's like a 40% reduction in interest payments.